Hi, Leith, and we missed last week's podcast because you were traveling, but we're back this week with another jam-packed session full of charts, full of data for to keep everybody up to date with what's been happening in the economy. How have you been? How was your trip last week?
Yeah, it was pretty good. So I went to Sydney, attended the SBS. They did an inside episode in immigration, so I was one of the contributors to that. Uh, yeah, it was okay. It's going to be aired on Monday. I don't expect much out of it because it's just ended up being well. I don't want to say a waste of time, but yeah, there was
That
too
was
many.
SBS Insight, wasn't it? Was that what
Yeah,
you?
it was. That's
Yeah,
right. It was
okay.
SBS. Look, they're very nice people who were there, but there was just there was too many people to talk, and it was just didn't get much airtime, and I didn't get the sort of questions I was hoping to be asked. Didn't get much. It was just yeah. It wasn't the most fruitful use of my time, put it that way. But it did kill two birds with one stone because I had my cousin's 50th birthday on Friday night, so I got to
Oh, very
basically and that was by pure coincidence. So that was great. I got to do the SBS thing, stayed in Sydney for a couple of days, worked and caught up with people I've been meaning to catch up with for about 10 years, and then
nice.
and then flew home Saturday morning. So it was pretty good overall.
Yeah, it's always an exhausting journey, isn't it, when you go to. So did you get delays at the airport?
Yeah, on the way there, I did. I got caught in a massive rainstorm, and it ended up being 5 hours to get from my house to SBS from where it's located because there's so much traffic. And
Yeah.
then you end up waiting
Wow.
around for 2 hours before you go on live air. And by the time I was on there, I was so tired, and I was actually trying not to fall asleep while they were taping, which is really hard because some of it was pretty boring, and I was just kind of like just pinching myself to try and stay awake, but not trying to make it obvious on the camera that I was falling asleep. And then they come to you and you're like, oh shit, then you're like, oh my god, like your brain's all frazzled because you've been up for 12 hours and you're knackered and you've been on the plane and whatever. But yeah, it went okay.
Yeah, it always last time I went to Sydney, it was I got caught in a storm as well. It was massive delays getting back on the other side. And I just, oh gosh, it was almost like doing like a international travel, just getting to the next state up. So yeah, it's always a bit of a nightmare when you go to Sydney. But well, that's good. So what time's that on Monday?
I got no idea. Look, to be honest with you, I'm probably not going to watch it live. I just can't be bothered. But because I was in it, so I know what was said, and I can't really be bothered. But I'll just watch back my bits and whatever when it's on demand. That's the easiest way to do it. And
This is your chance to give it a plug, Leaf. This was your chance for
oh, okay, yeah, well, yeah. If you
tell
want to
them
see me on
what they've been
SBS,
seeing.
if you want to see me on SBS Insight, watch SBS Insight. Otherwise, I'll probably just do a scissor reel of my own stuff, and I'll put it on my YouTube channel at Leith Van Onselen. So just wait for that because all the rest of it's garbage anyway. Just
Yeah.
joking.
Yeah. Well, we've got a fair bit to get through. I mean, we were having a bit of a chat before I hit record, but the first thing we're going to touch on, of course, is the rate rises. This is what everybody's worried about. We've already had an interest rate rise. My forecast has always been for rises now into the peak of this cycle, and then we sort of hit the end of the cycle that I forecast against, which is the land cycle, which runs on average around 18 years. So that will be sometime we would see a peak in land prices maybe this year, maybe pushing into next year, and then there would be a financial downturn into 2028. But that would be all rate rises up until the peak from where we are right now. Is that what the markets are forecasting?
Yeah, pretty much. So I'll just put up some charts if you don't mind, which will give us a good show of where we're at. Is that coming through?
It most certainly is, yes.
Okay, so basically, we got the CPI. So the Australian Bureau of Statistics is now doing monthly CPI. So that's overtaken its old quarterly CPI, and that is the indicator to look at now. So we got the CPI results for January, and the thing that matters is what's called trim mean inflation, and that's basically it's also called underlying inflation. So it's basically when you take the entire CPI basket and you trim out the most volatile items, and then you get this underlying measure, which is what the RBA looks at. And Australia's underlying inflation is tracking at 3.4% now annually in January, and that's tracking significantly above the Reserve Bank of Australia's inflation target. So they've got a target basically to keep inflation between 2% and 3%, and it's obviously at 3.4% through May. So as a result, it's tracking above that. That's shown at the bottom and the bottom left chart. Those two charts are from Alex Joyner at IFM Investors. the other key performance indicator the RBA has is basically full employment, but full employment without having inflationary pressures. And the latest unemployment read was that Australia's unemployment rate is tracking at 4.1%, which is about the lowest in 8 months. It's actually the same as it was the previous month, but that's together they're the lowest in about 8 months. And that's also tracking below the RBA's forecast as well. So based on those two things, you got a low unemployment rate, or lower than what the RBA expected, and you got inflation higher than what the RBA expected, or well, basically higher than it hopes, or its target means that we're likely to get further rate hikes. And the top right chart is the ASX's futures interest rate futures pricing. So that's basically what the market thinks on interest rates, and they've basically penciled in a 100% chance of a 0.25% rate hike in May, and then a very strong chance, like 80%, that we're going to get another rate hike before the end of the year. So that basically would mean if we got those two rate hikes by the end of this year, cash rate would be back to where it was before February last year when the RBA cut. And people remember that the RBA cut 3 times last year, or we've already given back one of those. The markets tip 100% chance of another one in May, and then very, very likely that we'll get another one later on in the year. So that'll basically bring us back to the peak cash rate we had recently. And what that means if you're a mortgage borrower, so I put some tables there in the bottom right, which is basically what I did was I grabbed the average new first home buyer mortgage size from the latest financial statistics from the ABS, which is 608,000 roughly for a first home buyer, and for an overall for just the mortgage borrower in general. So if you take every mortgage that was issued over the December quarter across Australia, the average size of that was 736,000. So for an average new first home buyer mortgage, each rate hike adds $96 per month. And so we've already added $96 per month to that average first home buyer mortgage. And then if they deliver 2 more, it's going to be cumulative $291 extra in monthly mortgage repayments. And for the average Australian mortgage holder, or new mortgage holder, I should say, it's $116 added in monthly mortgage repayments per 0.25% rate hike. So if we get 3 of them, it's going to be $353 added to monthly repayments. So obviously, when you've got people with mega mortgages or very big mortgages borrowing to get in the housing market, 3 rate hikes hurts. And it's, as I said last time, it's particularly pernicious for first home buyers who were sucked in on this 5% deposit scheme that came in the 1st of October last year. So obviously, these people came in on the Albanese government's 5% deposit scheme. If you're borrowing with a 5% deposit, that means that you're borrowing 95%, which means you've got a very big mortgage and you've stretched yourself to get in the market. And for those who got in after that policy came in, almost all of them would have gotten in before this first rate hike, the recent first rate hike. And then with the prospect now of facing 2 more rate hikes. So that average first home buyer mortgage size there, which is 607,500. Well, if you're on the 5% deposit scheme, it's likely to be higher than that. So it means that, these long-suffering, poor first home buyers who got in on this policy are basically, some of them are going to face a pretty difficult road ahead. Presumably they've borrowed, a lot of them have borrowed up to their maximum borrowing capacity. They've really stretched themselves. And now they're facing the prospect of, an extra $100, $200, $300, depending on how many rate hikes we get per month in extra repayments. So, yeah, it's a bit of a worrying picture for them.
It's very worrying. When I last spoke to Louis Christopher, who we mentioned in the last podcast, and the reason I bring him up is because Louis has a really strong track record of being very accurate when it comes to annual forecasts for the property market. And he also does a bunch of other stuff as well. I mean, he analyzes asset markets and equities as well. But his analysis to me was that one of the scenarios that he hadn't painted into his forecast was that there was going to be rate rises. He'd thought that was just going to be rate cuts. And he said to me, well, look, he thinks that if there was around 2 rate rises, it would potentially push us into a recession. But the other part of this that I think needs to be touched upon, and it was something that I discussed with Warren Mosler, who is known as the one of the founders of the modern monetary theory, which is this idea that rising rates doesn't really do much to control inflation. In fact, it can have the opposite effect. And if we think back to when rates were being slashed, it would have been for my subscribers in the first half of this cycle between, sort of 2012, up through the COVID era where we got, I think to 0.5% or something on the cash rate. It wasn't doing anything to boost inflation around that time. In fact, it didn't do a thing to change inflation in the economy. The inflation came from the supply shock following COVID. But Mosler, I mean, he would argue that a rate hike is not automatically contractionary because interest is income to the private sector. So when the central bank raises rates, the government pays more interest on bonds and reserves, which increases income to households, pension funds, banks, and other holders of government securities. So it effectively injects more money into the economy via higher interest rate payments and larger fiscal deficits, whilst borrowers face higher costs. Some asset prices may reprice due to higher discount rates. So his idea is that a system-wide that the policy can act like a fiscal stimulus to savers and financial institutions. So in other words, it's pushing more money into the economy rather than taking it out. In fact, it's stimulatory to more inflation rather than the other way around.
Yeah, I don't agree with him. So I mean, certainly for some people, so if you're a net saver, if you're a retiree, etc., higher interest rates are good for you because you'll make more income. But the fact of the matter is the contractionary or the amount of disposable income lost for mortgage holders far outweighs the benefit to savers. So net, it's actually contractionary. But he does make a good point in that it's not a great way to lower overall inflation because especially in the economy that we've got, whereby this inflation has been driven to a large extent by government policy, right? So the government's spending the government spending as a share of GDP is at its highest level ever. If you exclude the pandemic, it was slightly higher during the pandemic, but basically it's historically high. So the government's pumping demand. And also a lot of the inflation is actually coming from it's called administered price inflation. So that's inflation in areas that basically governments or regulators set prices. So if you think about all your utilities, so all your utilities pricing is set by regulators. If you think about your council rates or your car rego or those sorts of things, those are areas that are basically set by governments or regulators. And that administered price inflation is running over 7%. And because of that, so that's basically running at double the inflation rate. Now, so government's own actions or their own policies or the decisions of regulators is actually driving up inflation in itself. So obviously if the RBA hikes interest rates and it does squeeze out some of the private sector, but there's all these other areas of the economy that's adding demand. And really what we need, it'd be more efficient. So the RBA's only got one tool and it's very blunt, like just one single tool of interest rates. And they're basically trying to smash a tiny share of the economy to try and get inflation down when there's all these other areas where inflation's still being pushed up. And a lot of that is through government policy. And you see it also in the housing market. So the government's still running a very high immigration policy. And as a result, that's putting upward pressure on housing inflation. And housing inflation is 20% of the CPI basket. And so that's things like rents, construction costs. It's also got some other things too, like council rates, etc. But so the government is stimulating inflation itself. And really, if you want to bring inflation under control, like relying on the RBA to do it through one single tool of interest rates is pretty inefficient, and it's not going to work too well, and it's going to harm some people astronomically. And it's not going to work that well when the government's basically pushing the other way by funneling too much demand into the economy for its stupid policies. And some of those stupid policies are not just excessive spending, it's also excessive levels of immigration into a supply constrained economy. It's also idiocy, which I talked about previously around energy policy and those sorts of things that's driving up energy costs. And that then adds inflation throughout the economy, things like that. So really, we need our governments to basically pull their heads in and, run a smaller, better targeted immigration policy to take the pressure off demand and take the pressure off the housing market, and also if it's better targeted, we'll have better quality migrants who'll be more productive. We also need, obviously, energy policy reform, like to try and bring down energy costs through proper gas reservation, not this garbage that the Albanese government's done, which just will do absolutely nothing. And also through, obviously, abandoning this ridiculous push towards net zero and trying to run the economy off intermittent power and all this sort of stuff and all the transmission costs and everything, which is very expensive. And also we need, above all, we need the government to basically stop wasting money and spend money on things that give you the best bang for the buck, rather than just swishing money through the economy and all these boondoggle projects and all this other stuff.
NDIS.
Yeah. Well, I mean, look, to be fair, I'll say I've got a son on the NDIS who's severely disabled, but there is a lot of waste in that. And it could be run a hell of a lot better. And there are a lot of people on the NDIS who, quite frankly, shouldn't be. And I would have been just as happy if the NDIS never came along and we had the system that existed beforehand, which was way cheaper.
Regarding the NDIS, I mean, I speak to a lot of people that try to get on the property investment side of it.
There's a lot of that.
And some did it very successfully. I had a meeting with someone, I think it wasn't long after COVID that we met, and he was an investor in Adelaide, and he basically gave up his job, for his NDIS income that he got. But equally so, more so in recent times, I've spoken to a lot of people that bought NDIS properties in areas where there was a rampant oversupply. They overpaid for the property because they're very high cost builds for the high physical disability NDIS. Then they couldn't get somebody to tenant the property, couldn't get an SDA provider to tenant it, which means that they had to convert it to a rooming house, which now means that they're owning a property that is rampantly overpriced. They can't sell it because now it's also negatively geared, because the income from it being a rooming house doesn't cover what it would have got as an NDIS. I mean, it's been a disaster for for those people that jumped on it based on the promises of sort of wealth.
Yeah, and look, to be fair, some data came out today which showed that the NDIS has grown at 16% in the last year in cost. That's just unsustainable. I mean, it's 50 billion roughly, way ahead of what it was ever forecast to be. And the Parliamentary Budget Office thinks it could be, $100 billion in a decade. That's just rampant cost inflation there. And it does need to be pulled in dramatically and, really so much better targeted and controlled, because there's so much waste in there and too many middlemen who are just, middle people who are just clipping the ticket and earning, fat money off the government, off the taxpayer. So, yeah, it's a disaster. But effectively, we have a system in Australia whereby the non-market sector of the economy, which is basically your public servants, your health and aged care sector, which is driven by the NDIS, that most of the growth has been in that, education, etc. That's all called the non-market economy because it's basically government funded. That sector of the economy has driven most of the growth, most of the economic growth, and also most of the employment growth in recent years. And that is one of the reasons, the primary reason why Australia's unemployment rate's so low, because it's artificial, because it's basically being government funded jobs. And the government is just, the government as the size of the economy is too large in Australia, and it's gotten too big. And that's pushing up against, it's made us less productive as a country. We've also got low productivity from very high levels of immigration because, again, it's not very well targeted. It's too large. The size of immigration over really 20 years has exceeded the nation's business investment, our infrastructure investment, and our housing investment. And that's led to lower productivity and also higher inflation as well. So and of course, energy policy, there's a whole bunch of areas that are basically constricting Australia's productivity growth. And then what it means is if you've got low productivity growth, that lowers the nation's speed limit. It lowers the speed at which the supply side of the economy expands. So if you're pumping demand into a supply constricted economy, you get price rises. So ultimately, we're in this kind of stagflationary economy where we've got very low growth, but also high inflation. And now the RBA is responding with high interest rates, even though growth is poor. And we've got basically, our real wages are now tracking at the same levels that were in 2011. And Australia's real per capita household disposable income has been significantly lower over the last decade. Like the growth has been incredibly poor. It has been well below the OECD average. In fact, if you don't mind, I'll just quickly chuck up some charts. They'll only take 1 sec to get there.
Sure.
Because it just shows this. So I've got to scan through. Here we go. So on the left-hand side, Australia's real wages. So the blue is actual, red is the RBA's forecast based on the Statement of Monetary Policy. So our real wages, the RBA thinks that by mid-2028, the real wages in Australia, so that's the wage price index, which basically measures the growth in wages job for job, so it compares the same jobs. It's going to be by mid-2028, real wages are going to be tracked at the same levels they were in March 2011. So it's pretty dire. And real per capita household disposable income, which is the middle chart there, I plotted that this week. This is up to the September quarter from the OECD. In the last decade, or between the March quarter of 2015 and the September quarter of 2025, so that's 10 and a half years, Australia's growth in real per capita household disposable income has been lower than Canada, the United States, the UK. Those are the only English-speaking nations they had. New Zealand wasn't in there. But also significantly below the OECD average of 20% over that period, which is showed in red. So we're stuck in a low income trap in Australia, and that's really a low productivity trap, because as the chart on the right-hand side shows, that's from Justin Fabo and Apodi at Macro, Australia's productivity growth over the past decade, this labour productivity, so that's basically how much goods and services you produce per hour of work, has also been amongst the very poorest in the OECD as well. And the fact of the matter is, if we don't have productivity growth, or we don't have decent productivity growth, we're not going to have decent wage growth or decent income growth, because that is the bottom line. And the fact that the reasons why we have such poor productivity growth we've had excessive levels of immigration for 2 decades, again, overrunning, which has been higher than business investment, higher than infrastructure investment, and it's been greater than our ability to build homes. And that's just created lower productivity across the economy and higher inflation in things like rents and that sort of thing. We've had, obviously, energy policy failures. We've driven up the cost of energy, which has made our manufacturing sector shrink and added costs throughout the entire economy. That's made us less productive as well. And then obviously we've had this huge expansion of the non-market economy, like the NDIS, and got some charts here quickly. The top left is the expansion in the non-market economy since the start of 2023. That's from Alex Joyner. That's shown in orange. So most of our job growth has been in the non-market sector. The chart next to it, the second on the top, gross value added per hour work. That's another labour productivity measure. You can see in the non-market sector, it's been falling and it's tracking the same levels it was 2 decades ago. That's pulling down on productivity growth. We've had capital shallowing, which is the second chart from the right at the top. That's from Jared Minak. That's basically the amount of capital per worker has shrunk because we've grown the population faster than business investment and infrastructure. And the chart next to that, again from Alex Joyner, shows that the investment in new machinery and equipment is tracking at about half of what it was back in the 80s. Yet we've had population growth that is well above what it was in the 1980s. So businesses are adding machinery and equipment at a far slower rate than we're adding population. And that just means that we're getting less capital per worker, which makes them less productive. And I'll just explain that very quickly, just as in a stylized example, so people know what I'm talking about. If you run a cafe and you've got 2 employees working a coffee machine, and they can together churn out 100 coffees an hour, if you double the number of staff and you don't double the number of coffee machines, so you've got 4 people working one coffee machine, you can't double your output to 200 coffees an hour, because they're sharing the machine, there's congestion, they've got to wait for the other person to finish, etc. And as a result, their productivity per worker shrinks. That's effectively what's happened to the Australian economy. We've grown by 9 million people this century so far. Through high immigration, we've pumped heaps of people in, but we haven't added the number of coffee machines. Well, I'm just using that as an example. You know what I mean? The investment into the economy to keep up with that population growth. And as a result, the capital stock per person has been shrinking, or the growth in that's been shrinking. and that's harming our productivity growth. And that is fundamentally what capital deepening, which is basically when you grow your machinery and equipment and technology faster than you grow the labour force, has been the primary driver of Australia's productivity growth since the Second World War, and also advanced countries around the world. But in the last 20 years, we've actually gone backwards on that measure because we've added people so far more quickly than we've added business investment and infrastructure. So that's one of the main reasons why Australia's productivity stinks. And because it stinks, we're stuck in this low income trap. And one final point, obviously, they got the energy story I've got here, which the bottom left shows that energy prices have surged and that's shrinking manufacturing and etc. But this chart, second from the left on the bottom, is one I put together, and I've basically plotted the immigration rate. I've inverted it, so it's down is more. That's the green line. As the immigration rate's gone up in Australia, so we surged immigration, we more than doubled it in the mid-2000s, and we've kept it high ever since. Australia's GDP per capita growth and our productivity growth, because of that capital deepening thing I was telling you about, the capital shallowing, has fallen. So running a high immigration policy is absolutely stupid if you want to grow your productivity and living standards. But that's what Australia's been doing. And there's one final point I should have mentioned is obviously we're with Australia's housing system, that's shown on the far right as a sort of example of it. But we, as a country, have pumped too much capital, the nation's capital, into established housing. So obviously we've got some of the most expensive housing in the world. We've had a massive surge in home prices for the last 25 years, well, close to 30 years, really. And our entire economy now has morphed into being far too concentrated in housing. So this is just one example. Back in the early 90s, banks lent 2/3 to businesses, and they only lent 1/3 for housing and for personal lending. Now, that chart on the bottom right doesn't have the personal lending in line because that hasn't moved much. But now banks lend roughly 2/3 to mortgages and only 1/3 to businesses and personal lending. So we've completely inverted the economy in 40 years. And that just, again, is one of the reasons why business investment is so low in Australia at the same time as we're running high immigration, which then circles back to poor productivity growth. So I've gone on a bit of a rant here. But.
No, it's a good rant. I think it's an important one, but I do think that it comes down again to the taxation system. And this is the core argument of Georgism, of which, I keep going back. I'm, the former president of Prosper Australia, was that for over 10 years. But the idea is that the tax system dictates how you invest. And what we do in this country is we tax income and productivity very high. So it's a punishment on earning and producing things, which is the real economy, which is what you're trying to point out in these charts. And we encourage people to speculate in housing, not only to speculate in housing, but the idea is that you own your own home by the time you get to retirement. So from the word dot, people are basically breastfed on the notion that getting a leg onto the mythological housing ladder is a way to build their wealth, rather than working and producing things. And that is the system of the tax system. And it's part of what we'll go on to talk about when we come to CGT. But I think that the other aspect of this is that people don't realize how that impacts land use, because there's a lot of talk about, this is the cost of the deadweight taxation, which is basically the productivity cost for taxing income and capital very highly. What that actually does, it discourages people to work, it discourages people to employ with payroll taxes, whatever it is, it has a negative impact on the economy. Sales tax, or means that you produce less or you have to put your costs up, one or the other. And they try and calculate that as a deadweight cost, and there's all these studies. I think KPMG did a whole paper, of how much it
Henry
was.
Tax Review did it as well.
Yeah, but they don't actually look at how it impacts land use. Because just as your example of the person that, can't afford to get the extra coffee machine because, they're running a coffee shop, there's hundreds of coffee shops in
Yeah.
the nearby
And
vicinity.
the rent on that coffee shop is super expensive. So
So the rent's very high. They have to pay income taxes. They have to pay payroll taxes. They have to buy all the equipment, of which they have to pay sales taxes. On top of that, they have to pay their rents. Whereas if you get, I know we're moving over to electric cars, but it'd be the same idea. You get a gas station where they have a monopoly because there's only so many of them and the cars have to pull in there. You've got the self-service tills. They only have need maybe one employee in the shop during daylight hours. It basically pushes the smaller players out of the market and gives more monopoly power to the bigger players, like the bigger supermarkets, where everybody gravitates towards, so they don't have to go to 10 separate shops anymore. So this idea of, how taxation, the negative loss, the deadweight loss of taxation, they try and calculate it per tax, but what they miss is how it's actually impacting land use. And then we get to a situation where the government realizes that the only way we're going to keep an economy that is pinned on property growth, and as you say, the bank's lending predominantly against property, which is why the system has to collapse on itself at the end, because property prices can't just keep going upwards. There has to be a reset at some point. At some point, the debts become too much for people to be able to service. It's not taking in, they have to run it on population growth. It has to be a Ponzi system. There always has to be a new buyer to buy in at the bottom end. There always has to be somebody with money to buy at the bottom of the pile in order to keep the party going, so to speak.
can I add something to so 100% right, the tax thing, but it's even worse than that. And I'll tell you why. So obviously we've got a tax system that incentivizes overinvestment into housing, right? That's pretty obvious. But also we've got a tax system that then encourages the federal government to run a high immigration policy. And I'll tell you why that is. So, and I'll use Norway as the counterfactual. So Australia is obviously an incredibly rich resource country, but we don't tax our resources properly. And as a result, our tax system is super reliant on personal income taxes. Right? Personal income taxes is the largest and it's the fastest growing area of taxation. And the federal treasury, which collects 80% of the nation's tax revenue, sees, because we're so heavily reliant on personal income taxes, they're like beauty. We can just bring in a whole bunch more people through migration and we can bring in way more income tax, which is what they do. So the Australian Treasury runs a high immigration program because they can bring in hundreds of thousands of people every year who work, who then generate income taxes, which the Australian Treasury captures. But they don't bear the cost of that high immigration because the cost of the high immigration predominantly falls on the states, which have to provide the infrastructure, the education, the health services, and most of the other stuff falls on the states. Also, it falls on us as private individuals because the states then sell everything off and then we've got to pay user pays fees to go anywhere, which then basically means we pay private taxes to, say, Transurban to go on a toll road. When previous generations, you didn't have to pay for toll roads, etc. Now, here's the counterfactual. Norway taxes its resources properly. And that's probably the best example in the world of a country that actually taxes its resource wealth properly. So Norway taxes its oil and gas exports from the North Sea incredibly high. And part of that's because they've kept a lot of it in public hands. And as a result, Norway has a country of 5.5 million people, has created a sovereign wealth fund whereby it basically has got all the tax revenue and all the royalties from its oil and gas. It's funneled it into an investment fund called a sovereign wealth fund, which then invests overseas. It's the biggest shareholder in Microsoft and all these companies. And that sovereign wealth fund is now worth $300,000 US on average per Norwegian citizen. Now, because they're sitting on this massive mineral wealth, which they've generated by taxing their mineral wealth properly, this massive sovereign wealth fund, Norway has a direct disincentive to run a high immigration program. Because if Norway did what we did and say it doubled its population in 40 years or whatever, so it went to 11 million people instead of 5.5, well, then its sovereign wealth fund is no longer worth 300,000 US per citizen. It's worth 150,000. So you literally make your country poorer. But Australia does the other thing. We don't tax a mineral wealth properly, and we tax personal incomes punitively. So as a result, Treasury runs a very high immigration program because that's the easiest way to generate tax revenue without worrying about all the costs and all the other problems it creates. Because Treasury, that's not on the federal budget's purview. They don't care because that falls on someone else's ledger. But if Australia had taxed its resources properly, similar to Norway, or not even as punitively as Norway, but just way more stringently, Australia would then have a direct incentive not to run a high immigration policy, because when you bring more people and you grow Australia's population, you actually dilute your mineral wealth per person. Because what Australia sells to the world in iron ore, coal, natural gas, gold, nickel, manganese, all these other things that we export is independent of the size of the population. So if Australia's population was 20 million instead of 28 million as it is currently, we'd effectively have more mineral wealth per person. And if we tax the stuff properly, we'd have more tax revenue per person from a resource wealth. But if we grow the population aggressively, you get less tax revenue per person. But unfortunately, this sort of circles back to how we've devised a tax system that creates bad outcomes. It creates bad outcomes because you get overinvestment in housing rather than productive investment, which actually grows the economy. So you don't get enough business investment, not enough infrastructure investment, you get too much in housing. You also have excess demand for those things that you don't have enough of by running a high immigration policy, because that's the easiest way of getting personal income taxes, when the solution is to actually cut personal income taxes and tax things properly like land and resources. And if you did that, you wouldn't run a high immigration policy because that'd be self-defeating and detrimental. But this is just the way that Australia is just warped, the way we have a policy set in this country, and it just creates negative outcomes.
Of course, this brings us back to the initial discussion about the rate rises, because now we have a tax system that's encouraged people to overinvest in housing, and we have a banking system that lends predominantly against land as collateral. Once you start putting rates up, then you risk property prices, particularly at this stage of the cycle, where people, it's going to put a squeeze on costs and it's going to impact the market at the margins, which means that you're going to get a slow rise in defaults. It's going to push people potentially to a point where they can't afford to manage the mortgage payments, because the productive sectors of the economy have been eroded away through the years by the tax system. So where we are at the moment is we're running this rampant immigration program. We're pushing most of the investment into property. The government is supporting the employment market, through schemes like NDIS. So we have a system that's essentially very, very shallow, very fragile economy that's very shallow. And that means that a rise in interest rates, if that does impact the property market, and it already is, because I can tell you it was certainly in Melbourne and Sydney, which are
Absolutely.
our two biggest markets, property markets, the clearance rate is dropping. And the clearance rate, although people rubbish the clearance rate a lot, no matter about that, if you put aside the fact that there are a percentage of results that are not reporting, it is an excellent leading indicator of where prices are going. And of course, what we're seeing at the moment,
100%.
clearance rate is softening. So if we get a situation where people start defaulting on their mortgages and property prices start to go down, particularly when we've pushed a lot of people into the property market on the 5% deposit scheme, then we're risking property prices dropping so far that they drop below the loaned funds in the bank. This is what produces a financial crisis at the end of the cycle, is that you get, gradually property prices start to slip. You get an increase in supply from people that can't afford their mortgages and need to sell or need to downsize. You don't get that absorption on the other end because the economy is at capacity, so people can't borrow more in order to get into the property market, and keep propping prices upwards. And we end up with potentially quite a severe financial downturn at the end of it. I mean, that's what causes a financial collapse. And we have short memories in this country, because we remember back to 2008, which was the last land-based led recession, the subprime crisis. And of course, we avoided it because Kevin Rudd did bail us out effectively with home buyer grants and bank deposit guarantees and infrastructure spending. But if you go back to the 1990s downturn, there were a lot of bank collapses over that period of time. It was an extremely severe property crash, and even worse, commercial property crash.
Yeah. So to your point about auction clearance rates reflecting house price, they certainly do. Because I wish I don't have the chart here to show it, but when I plot them on like a monthly average basis, so not week to week, but if you grab like the average for February, the average for whatever, Yeah, it does. It's a really good leading indicator for prices. Really, only in Melbourne and Sydney though, because Melbourne and Sydney are the auction markets of Australia. The rest of the cities don't do them. There's not enough volumes to really count. They're basically private treaty markets. But it's
Brisbane's getting up there now.
yeah,
There's,
it's only 100 and something a week
yeah.
though. It's not. It's still a private treaty market overwhelmingly. But interestingly, I've got a chart here on the. So as we know, Melbourne and Sydney have lagged. Um, Brisbane, Perth, Adelaide since the pandemic. So that's shown pretty clearly in a longer term view on the left from PropTrack. Massive difference. But even the high frequency data from Cotality, so I've done it on a 28-day basis and it doesn't go back as far. You can see that Sydney and Melbourne prices are about to turn negative. So in the last 28 days, they've both recorded zero growth, whereas the other markets are still experiencing, strong gains. So we've got this sort of two-faced market at the moment, whereby the smaller, large capitals, if I call them that, Brisbane, Perth, Adelaide, are still experiencing strong growth, and they're actually accelerated a bit lately. Melbourne and Sydney are now falling back, and that's reflected in the auction clearance rates, which have fallen for the final clearance rates have fallen, I think, for 3 or 4 straight weeks now, and very high auction volumes now in Sydney and Melbourne as well. So it's partly been weighed by auction volumes, partly been weighed down by the rate hike and the expectation of more. Now, it's interesting because I had this debate with actually, sorry, I didn't have a debate. Michael Matusik, who writes a property newsletter, he wrote a really interesting report recently saying his argument was basically all real estate is local. And he was just saying that how is it when we've got the same interest rate policies, the same lending policies across the country, that you have these wildly divergent outcomes between, Sydney, Melbourne, Brisbane, Perth, Adelaide, I should say, versus Sydney and Melbourne. And he was just saying that, there's all these local factors that matter. And he's right to a degree, because here's some charts that Alex Joyner at IFM Investors put up about 6 months ago. And yeah, they're 6 months old, but they really do illustrate the point. And it basically shows you why Brisbane, Adelaide, and Perth have had such strong house price growth, whereas it's been softer in the other places. Basically, those 3 markets, their working age populations have grown significantly faster than the pre-pandemic trend. And you can see that in the top 3 charts. Like, they've had a trend break in population growth, whereas Sydney, or it's shown here as New South Wales, but it's a similar point. Sydney's population growth is basically back to where it would have been had the pandemic never happened. Whereas Melbourne's, or Victoria's in this case, but Melbourne's is still tracking well below the pre-pandemic trend. And it's interesting because those 3 markets at the top have had, obviously, the very strong house price growth, as shown on the left here. Sydney's had decent house price growth, like 45% or something since March 2020, but significantly less than those, which have basically doubled. Whereas Melbourne's had the weakest. And yet New South Wales's population growth is merely back at the trend, and Victoria's is well below the trend. So that is sort of what I think Michael Matusik was getting at, that there's these, the population growth, well, this is at least how I read it, the trend break in population growth versus the pre-pandemic is the fundamental reason why those 3 markets of Brisbane, Adelaide, and Perth have gone gangbusters. Sydney's has just gone okay, because it's basically just steady as she goes. Like, it dipped and then it rebounded. It's basically where it was where it was going to be anyway. Whereas Victoria's, or Melbourne's population is still well below the pre-pandemic trend. And the main reason for that is not because we haven't had enough migrants coming in. Our migration is actually higher than it would have been before the pandemic. So our net overseas migration is actually, in the last 5.5 years, has averaged 266,000. That includes the pandemic border closures, which is the highest 5.5 year period in a nation's history. So we've had very strong net overseas migration, stronger than the pre-pandemic trend, but it hasn't been distributed evenly. And Victoria's had a lot of residents leave Victoria. So we've had heaps of net migration out of Victoria since the pandemic.
Yes,
That's the main reason.
Yeah, I kind of want to make a point on that because I think I do a lot of historical research on the land cycle. So for your viewers, they won't necessarily know too much about the land cycle. It's an 18-year cycle. It was there's always been an 18-year cycle in cycle theory. But it was first related to the land market by two economists. One was called Homer Hoyt, the other one was called Roy Wenslick. Homer Hoyt wrote a book called 100 Years of Land Values in Chicago, which was it was his PhD thesis. And the reason that he wrote it and the reason that he looked into the property market was because he had had such poor property investments and he wanted to know why. Why was he failing at the real estate game? And he wrote this book, and it was about Chicago's land market. He also theorized that this cycle might be America wide when he wrote the book, but he found that there was this average on average 18-year cycle in Chicago. And Roy Wenslick, who wrote The Coming Boom in Real Estate, which was published in 1936, which was Roy Wenslick was a valuer. He was born into a real estate family. Looking at data was one of his passions. And when he looked at property data, and a lot of people were doing it at this time because because of the Great Depression. They wanted to know why the Great Depression had happened. And actually, when you research the Great Depression, much of what happened was due to land speculation. The money that was made in Wall Street went into the land markets, which then blew up, which caused a lot of bank collapses and smaller bank collapses at that period of time. But Roy Wenslick also discovered exactly the same cycle as Homer Hoyt and said, there's this on average 18-year cycle, and it applies to the whole of the US. And when those books came out, I mean, the publishers went wild on them. They marketed them to real estate professionals and said, you need to go and buy this book because this is going to teach you how to speculate on land, right? So it became this, oh, hey, we can forecast the markets. But my reason for mentioning this in this context, and it wasn't just these two authors, they're the most famous authors. There's a tremendous amount that's been written on Homer Hoyt, not so much on Roy Wenslick, but there were numerous other authors independently at the time that did international studies. John Riddleman, Clarence Long, Warren Pearson, a lot of very well established economists that looked at Glasgow, that looked at Scotland, that looked at areas of Europe, that looked at that found also that there was this average 18-year cycle. And when they did their analysis of their academic papers, they did an analysis of what is causing property prices to go upwards, and all of them, the initial stage of the cycle, of which there are 20 steps when you look at the analysis of Homer Hoyt or Roy Wenslick even, is that you had population growth going into areas of limited supply. So when you have population growth that is flooding to cities, as we've seen over the last few years at quite a rapid pace, the supply cannot immediately accommodate that because most of them are going into the job centres. They're not necessarily going into regional areas where there aren't any jobs. They're not becoming farmers or sprawling outwards. They're going into the job centres. There's not available accommodation there, which means that it increases rents to begin with, which therefore increases the earnings of the land, and therefore has a roll-on effect to making it more profitable to develop and more profitable to build, and putting property prices up, and that is what those charts are what you're showing there. So I always say to my subscribers, don't waste money on really expensive hotspot reports that are looking at short-term indicators. You need that you can find all this information out yourself. Just follow where the population's heading, understand where we are in the bigger 18-year cycle, but also follow where that population is heading, because this is a prime example of why we've seen Perth explode, for example, of which attracted population during the COVID pandemic by paying FIFO workers, giving them a mortgage effectively to go and work in Perth because there was such a shortage of workers.
Yeah, and also you can see in the bottom right there, I've got this is the latest change in listings over the last year from Cotality, and Adelaide's an anomaly here, which doesn't fit this mold. But you can see that Brisbane and Perth have got, they've had a massive fall in total listings in the last year. And they were like Adelaide's. If you were to do this, if Cotality was to do this over a 5-year period, it'd be even worse. Because I know South Australia, if you take a longer term view, its listings are lower today than they were 5 years ago, for example. Whereas Sydney and Melbourne have basically have got relatively abundant listings. And I did have, there was another chart that's about 3 months old. I didn't want to use it, it's 3 months old, but CBA did a great chart on this, on these totality listings, where it basically mentioned it had listings currently versus 5 years ago versus 10 years ago, or something like that. Or maybe it was 5 years ago versus last year versus now, or something. And it basically showed that listings in Melbourne and Sydney were basically where they were 5 years ago. So they hadn't shrunk, but they were way lower in the other three major capitals versus 5 years ago. And then
Yeah.
that there gets into the scarcity story, right? So they've had this big spike in population growth relative to the pre-pandemic trend. That's led to a scarcity of homes for sale because versus the population growth, which is then driving this, much stronger price inflation in these areas because it's got this relative scarcity. So I think that sort of gets to what you've been saying.
Yeah, and you may then wonder, well, how then could we possibly have a downturn? Because if we're looking at population growth going into these markets of tight supply, and this is the argument that gets thrown at me a lot, is, how could we possibly have a downturn because there's not enough stock to absorb it? So surely that's going to keep upward pressure on prices. And it does until it becomes too expensive for
Yeah.
people to own the real estate, because the metrics of supply and demand, when you look back, for example, to the 2008 crisis, it would be like, or even to what happened in COVID. But 2008 is a good example of what happened sort of in January of that year, when it was dawning that there was a financial crisis and that there'd been the downturn in the stock market that had happened in October 2007. Is you saw a huge boom in the vacancy rates all of a sudden, and that is investors, selling. But one of the studies that we did at Prosper Australia, of which I wrote two of them, was the speculative vacancies report. It got the most publicity of all the reports, and it was looking at how much vacant housing there was based on water data usage. The last report that we did showed that there were potentially 100,000 properties, over 100,000, but to do it as a round figure, properties that were vacant in the greater metropolitan area of Melbourne that had been vacant for a year or more. So even though we're talking about shortages in properties, one of the factors is that there's a lot of property out there that is underutilized and not being used. So you've got a dual factor coming, that when there is a financial crisis and people need to generate income, first of all, they sell off the housing stock that they've got, their poorer assets, or they try and generate income from assets that they're holding that maybe, they're holding vacant or whatever. But the other one is, of course, is if they can't afford their mortgages, then they need to sell. And that's where you get a rise in delinquencies or, foreclosures. And it's actually quite difficult to the foreclosure process is very expensive for the bank. So it might be worth looking into that at some point. But these short-term metrics, such as supply on the market and vacancy rates, can change very quickly when the economy goes through a crisis compared to what we're looking at right now. As can
Yeah.
migration, trends. I mean, you can be looking at rampant migration, but as soon as an economy goes through a panic, people rush to where the jobs are. So they're not necessarily going to be rushing to Adelaide anymore or Brisbane. It could be that if you look internationally, it's probably better for me to use an international example. You'll find this is why the premium London market, for example, will hold up better in a financial downturn, because it's considered a place of safety, to store cash. You'll get a rush of migrants going into that area where there's a lot of job diversity and where they've got a better chance of securing employment, or it's used as a store of cash. And remembering that one of the policy implementations that was done in the 2008 downturn by Kevin Rudd was to enable temporary visa holders to buy established real estate with no need, whereas before they hadn't been able to do that, and so we did have a rush of overseas money come into those markets. So that those go into it's the bigger capitals by population that are the ones that are going to recover quicker out of a downturn, because potentially they get that population growth coming in, or they get the rush for the safety of overseas capital.
Yeah. And also, I'll just add, in a downturn, it's people tend to go to group housing, right? So we saw it at the start of the pandemic, but basically, although you can have a structural undersupply, and to be fair, it's real. It is a real structural undersupply because people shouldn't have to live in group housing, etc. But in a full blown recession, you're going to have kids moving back in with their parents. You're going to have adult children. I'm saying moving back in with their parents. You can have people moving to group housing. The average number of people per dwelling can increase quite sharply. And when that happens, you can have a massive surplus of homes on the market. Now, that's obviously not, an optimal situation from society's viewpoint. And this is why I get annoyed when people say, oh, look, there's lots of houses with spare bedrooms. Therefore, there's no housing shortage. And we just need to use those bedrooms better. I think that's ridiculous. But the fact of the matter is, though, you can get swings in demand because you have a decent rise in number of people per dwelling. And when you've got 11 million, I think it is, dwellings in Australia, you can have a 0.2%, or if the number of people per dwelling goes from, 2.5 to 2.3, sorry, the other way around, goes from, say, 2.5 to 2.7, that can be the equivalent of hundreds of thousands of properties.
We saw it in the census, in the 2016 census. Was it 2016 that they did it? That there was a slight uptick in the number of people per dwelling. And that changed this is the thing. I think when we did a podcast with Cameron Murray, he was talking about this, you forecast based on where the data is now, and you just think that it's going to carry on going.
Yeah, it can change, it can swing.
And all of a sudden you get a new piece of data, and like all the forecasts change, or how much accommodation do we need suddenly changes, so these forecasts, these are metrics that can change very quickly. There's long-term indicators, over time our population is going to keep increasing. But
and also we're going to have an aging population, so the number of people per dwelling should be falling, right? Because our birth rate's only 1.5 per children per woman. So over time, the number of people per dwelling must reduce. Otherwise, we've got a problem.
Interestingly enough, the argument used to be, and this was done, a lot from industry professionals that would spruik. There's the way forward investment was to invest in apartments, because we had an increasing number of smaller households, right?
So people don't
live until that 2016 census, that was the idea. But the increasing number of smaller households was basically the aging population, where the kids were moving out, or one had died and the other one was rattling around in the suburban home because they
obviously don't want to move. They're like, a lot of them don't want to live in high-rise dog boxes. I wouldn't want to move in them.
Yeah, why would you?
But that's the other thing. So we've got a higher share now of Australia's dwelling construction is now shoebox apartments.
Yeah.
Right. In fact, most of the apartments built in Sydney, Melbourne, Brisbane, I didn't include the chart here, unfortunately, but built over the last decade have been shoeboxes. They've been bed sits or one bedrooms. And so if you're building shoeboxes and that's become, one of your dominant forms of housing that you're building, well, that means the number of people per dwelling has to fall. Because, so I do get annoyed when people say, they try and quote this, we've got spare bedrooms and whatever, and we just need to utilize them better. That's just ridiculous. And
you can't
base society on that.
Well, not only can you not base society on that, but you can't legislate for it either. There was a lot of scare media that came out that said, they're going to tax spare bedrooms, but it is impossible to legislate a tax like that. Nowhere in the world has that been able to be done. The only way that you could do that would be on council housing, which is, where you have an absolute understanding of how many bedrooms there are in a property and exactly who is living there. But we have a transit of people going in and out of properties being rented, people having kids. What is a spare bedroom? What is a work office? You can't legislate for that. This is the argument really for reducing taxation on income and productivity and putting higher taxation on land, because a land tax employs land into use. If you've got a property on a big block of land and you're not fully utilizing that property, then paying a higher land tax would then encourage you to either downsize,
turn it in an income producing asset.
Yeah, and obviously that needs to be done as a tax switch, not as and I'm not advocating for just increasing taxes per se, but I mean this was a tax switch that all the classical economists advocated, and then Henry George became most famous for advocating because he did it in a way that captured the public heart at the time. But whether we'll ever see that happen, I don't know. Well, Victoria's done a great way of doing it now. They've increased land taxes and they've changed the dynamic from an investment market to a home buyer market. But yeah, we haven't done much on the CGT, and we might have to leave it until next week. The way that we're
I'm easy either way if you want to leave it or you want to quickly discuss it. It's up to you.
Well, why don't we leave it for next
All
week?
right.
Because we've sort of gone through a tremendous amount today, and we want to give everybody something to go on. The CGT is important to discuss because that all is in the news. We touched on it last week with the comments, and I wrote actually I was writing my report last week for my subscribers was about the CGT, and I was writing about Tom Panos, and then I went and checked with you, and you'd pretty much written the same thing about that, but. His remarks obviously about how it wasn't going to be great for renters and the impact that it was going to have on them rather than really addressing the concerns in the industry, which is how it's going to take away speculation in the land market and potentially impact real estate profits.
Yeah, absolutely. It's definitely look. It's not going to go away. So if we talk about it next week, it's going to make. It's not going to be like, oh, gee, we've missed the boat because it's not around. This is going to be in discussion for weeks at a time because right up until the May budget, and it looks almost definite that we're going to get a CGT reform.
Mm.
And so whether we talk about it next week or even the week after, it's not going to matter because it's going to be a talking point right up until the May budget and,
Mm.
and probably afterwards as well.
Mm. 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 Yeah. So, well, we'll leave that till next week. We'll leave it there. And thanks, Leith. We will catch up again soon.
Yeah, no problem.